The way we've tried to construct the portfolio is really kind of orientate ourselves towards businesses that carry characteristics like high returns on invested capital, high recurring revenue, very strong EBITDA margin profiles for the industries that participate in, and low debt. One of the things we've tried to do is, if you think about the portfolio, roughly 60 to 80% of this is what I'll call compounding growth stocks. So these are companies that have those characteristics of returns on invested capital, of recurring revenue, of margin profiles, debt, and industry structure is also important to us. We like to play with a top 3 player. Like, we don't want to necessarily participate in a languishing asset. Within healthcare, West Pharmaceutical, coming after the COVID bump. Some of their products were heavily used in the vaccine administration across the world, frankly. And so they were coming off that COVID high. It presented us, for example, an opportunity to participate in a class-leading business that we thought was an attractive valuation. And we complement that with 2 other buckets in our portfolios. One side of that is roughly 0 to 20% can be aggressive growth stocks. And they might have qualities that you might think of in certain places of retail or technology or even healthcare, for example. MongoDB is a company with the software space. So a few months ago, there's 300 companies using AI vendors using their product. As of today, there's 1,500, for example. So, that is a company that, AI or generative AI wasn't necessarily the core business, but their technology is adapting. The other side of that pendulum is another 0 to 20% is what I'll call life cycle change. And as you think about that name, it really represents, a change. It could be a manager change. It could be a business model change. It could be debt restructuring change. But we like the core business is misexecuting or it's being misappreciated by the market for one reason or another. And, that we think presents an opportunity as it might go through this change, likewise creating alpha and hopefully beneficial to the portfolios. GFL, for example, it is a waste management company, actually based out of Canada, but has big business operations also here in the United States. But that is one where, it was going under a transformational change of its balance sheets. They were digesting some M&A over the last couple of years, and likewise with that came some debt. They decided this year to sell some of those assets, and we think this is the opportunity to participate in that transition of that business model. We try and have a matrix approach. Are we going to hit everything? No, we won't. But I think what we're trying to do is put the odds in our favor, be consistent with our process, be methodical. We're not going to just chase a trade to chase a trade. I think it's a great time to look at the space broadly. I think the companies, they carry that dual dynamic risk and return. I think that's why personally, I have gravitated my personal style. I love the characteristics that many of them present.